Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to be joined this week by Mr. Chris Bake, the member of Executive Committee of Vitol, to be the final person sitting in the seat this year to reflect on the year past and maybe a little bit of an outlook for the year ahead. Chris, welcome and thank you.
Thank you very much, Sean. What a year it's been. I feel honored to be here and have a chance to have a chat with you and catch up on some of the craziness that we've seen and continue to see, by the way.
Yeah, well, you have the last word, so to speak, on this year, at least at Gulf Intelligence. Let's kick off with the old favorite chestnut oil prices. We've seen a year in which we've had the low of $48 on Brent, the high of $86.70. That's a pretty big spread, if you like. Certainly we're closer to the top end now, but that's the journey it's made over the year. What kind of are some of the three big surprises you think in 21 that sort of said, oh, they moved the dial a little bit?
Well, I think several things. Number one is the resilience of OPEC to stay the course. Number two is the lack of price response to incremental U.S. production. We haven't really seen a huge surge in production from the U.S. And number three, most recently, is probably the political willingness, especially in the U.S., to try and manage and curtail prices in a seemingly contradictory way, i.e. an administration who's very supportive of renewables and alternative energy, but is also desperately trying to force prices down in the U.S. at the retail pump to encourage passage of a key bill that this administration wants to pass, the Build Back Better bill. So there's a lot of dichotomies in the market today that are as we all typically experience, further exacerbating those push-pull balances.
There's certainly the contradiction, one would appear, in the Biden administration's policy to be actively seeking more oil supply from OPEC plus countries, and at the same token initiating policies in country to curtail oil production. We had the Saudi energy minister this week use pretty stark warning sort of signals for everybody to consider that under this current strategy, we could end up seeing 30% of global oil production lost over this decade alone. That's a pretty dramatic. Does that sound like hyperbole, or is there a pathway to some truth that could be the case?
No, I think if you look at the international oil companies and their stated production objectives over the next 10 years, for example, BP, and on the path to net zero 2050, they all have to not only mitigate carbon production, and through offsetting means, but they've also got to reduce carbon production through less production of hydrocarbon. So I think it's not by any stretch overstated, and I think the issues around that probably are best expressed not only through the pricing of the oil markets, which, relatively speaking, despite a return to regular wave after wave of pandemic, but that the resilience of demand has been there, and the lack of alternative investment, specifically seen here in Europe in the price of gas, is very much manifest. So I think it can be a indicator of more volatility to come, and that is going to be very difficult for the OECD to deal with over the next few years.
We saw also in the last few days talk of Halliburton possibly taking over ExxonMobil's oil concession in Iraq. The question I have to you, and a sort of follow-up of what we were just talking about, does this sort of transformation of the oil upstream opportunity and the access to capital for it create opportunities for new actors like Halliburton, but also not unlike yourself, Vitol, or your peer group?
I think that there will be. I think it's a dangerous environment where, shall we say, responsible capital is somehow replaced by less responsible capital. But it's also a trend, and it's not to say Halliburton or ourselves are less responsible capital, but especially in it's one of the pushbacks from the debt providers in, for example, the coal market, is that if we orphan assets left, right, and center and attract less responsible capital, the management from an HSE and ESG footprint point of view can be more problematic. But you're also seeing a massive refocus by all the major players the established major players in the upstream sector to try and narrow their scope of activity and concentrate their scope of activity, because they are needing to consolidate their capital allocations to the sector. And they are therefore going to attract other players, be it service providers or companies such as ourselves, who have this year acquired sizable acreage in the US Permian Basin, for example. They're going to attract us into the marketplace and pursue those opportunities.
On the other side of the coin, of course, Chris, there is the demand side, and the challenge to supply, as we just articulated. But on the demand side, also a little bit of a question mark emerging in China, the world's largest oil importer now. We're seeing for the first year on year, the Chinese oil imports decline, first year in 20 years or some number like that. Clearly a wobble in the China demand story. Your thoughts on if this is the start of a trend or a one-off moment for China?
No, I think very strongly here. We're seeing the events of the last 24 months play out. So Chinese year-on-year crude demand growth was around 600,000 barrels a day. Last year, we saw China uniquely placed amongst all the developed economies, have the ability to incrementally absorb up to 1.2, 1.3 million barrels a day incrementally year on year from 19 to 20. So you saw a massive surge in imports into China, especially in the low price environment. They were very, very price responsive to the incremental building of inventory. Remember, April, May, June last year, we built over 1 billion barrels of oil as the global demand equation.
At sub $40, so inevitably very attractive.
At sub $40, as the global demand equation slowed down, the Chinese were one of the fastest to be able to respond. And I think the effect of what you're seeing this year with the lower net import numbers year on year, 2021 in China, is the unwinding of that inventory build that was acquired last year. Now, obviously, there is a strategic level to that inventory, so they're not going to continue to unwind ad infinitum, but they were able to take advantage of that pricing range that you indicated in your question a few minutes ago, as to, low 40s up into the $80 a barrel. They certainly were able to liquidate some of the incremental inventory that they built over time. And they probably were some of the most responsive on a national level of being able to do that. So to answer your question, I don't see a change in trend or dynamic. I think there continues to be efforts in China to curtail coal. Gas consumption continues to grow. And I think pending a further contraction of the economy, which it will contract slightly, partially driven by national strategy, it will contract slightly, but we don't expect a continued curtailment of demand.
Well, it's hard to deny that the trend line in China's economic growth is clearly downward, as it would be and it has been in the past for any economy moving from a developing to a developed economy. The OECD average, putting COVID aside, 3%. China seems to be on an inevitable journey to that OECD average. And my question on that is, what impact will that have on the world economy, on OPEC, on international oil markets? Are we even, is that being baked in, or are we being in denial to that? Or how do you see that playing out? Because we're now down to 6% this year, forecasting to 5 or under 6 anyway for next year. The line is...
Yeah, but I think in terms of quantum of accelerated growth, Sean, maybe you're going to see less year-on-year incremental growth, from 500,000 to 1 million barrels. Maybe that gets curtailed, but we're not going to erode fundamental base demand for a little while yet, and that is going to depend again on sustainable or renewable alternatives, which are definitely growing in China as they are in other parts of the world, but are still not in any way capable of undermining base demand.
Right. Listen, Chris, we've seen recently coming out of the UK and coming to our neighborhood here, COP26 just ended. COP27 is coming to Cairo. COP28 is coming to Abu Dhabi. And in that sense, the world coming out of COP26 seemed to face a sort of a difficult decision of whether the great energy transition was going to be a cliff edge jump, if you like, or and abandon the primary energy source of the last 100 years, or are we going to transition down, with carbon management to a new sort of energy fuel mix that is low carbon? I'm wondering, from your point of view, in a lot of ways, the hydrocarbon industry was excluded from COP26. How can we earn a seat at the climate solution table while sustaining some sense of market share within the new energy fuel mix? It's a big Rubik's Cube problem. What are your thoughts on that?
That holistically, we need a hybrid solution. Unfortunately, we don't have sustainable renewable capacity to in any way meet the current demand for energy. So hydrocarbons is part of the mix. I think abatement, offsetting, capture are all tools that need to be put in the war chest against climate change. No one, at least around me, is denying that. But if we also want to have sustainable economies and base energy demand, we have hydrocarbons as part of the mix for the medium-term future. Now, that also means we as an industry need to continue to embrace the challenge of climate change and certainly support a transition to more sustainable renewable energy sources. But as we're going to see, as we've seen in the past week again, the lack of available hydrocarbons, specifically the gas market, where gas on a barrel basis is trading in excess of $250 a barrel in Europe, or energy prices are equating to numbers in excess of that. The world where we don't have hydrocarbons is going to be very difficult for us economically, and we need to continue to try and find the balance.
I mean, has the sort of horse bolted the stables already? The train left the station, whatever analogy you want. Oil and money seems to have parted company. I mean, somebody said to me the other day, why would I buy a combustible engine car if I know I can't sell it to anybody, if they're not going to buy? Why would a bank support an investment in a new exploration and production field for a 25-year cycle if it's going to get torpedoed? I mean, the idea of oil and money, is that Humpty Dumpty, can it put me back together again? Or are we on a slope here that is a cliff?
Listen, the awakening and the discussion around the climate issue and the hydrocarbon role in the climate issue has been very prominent the last 2 years, and I think we totally embrace that. But by the same token, we think that the pendulum will swing. Or, anyone walking into COP would dare not discuss oil or oil issues, but post COP, in the conference in Houston, there was the large conference in Houston 2 weeks ago.
Yes.
And beyond, there was a willingness to address some of the fundamental issues of non-investment in oil and what the possible consequences would be. And as all things, I think we need to find that balance between the two, because we can't continue to pretend like we don't need to sustain ratable oil production for the near term or even for the medium term. As much as ourselves and Vitol, we've got 1.5 billion plus of balance sheet allocated towards sustainable and renewable projects. We're continuing to aggressively invest in them as best we can. But the base business and the base demand for energy, especially for transportation and electrification, continues to be on a swing basis, continues to be the hydrocarbon. So
it looks to me like this wrestling match, or this divorce of oil and money, may be fought out on Wall Street. We're seeing activist shareholders have a real impact and making a wedge in there, that their influence seems to be one of the takeaways of 2021.
I agree, and we've seen the boards of companies like Exxon now have presence on those boards by activist investors who are helping Exxon make capital allocations over the medium term. And again, that is a dialogue that we think is necessary and welcome. What we also want to try and do is help context that, because until we can find a way of storing and distributing renewable and sustainable energy in more holistic terms, and at pricing sets that are affordable to industry, we can argue what affordable means. It's going to take a little bit of time. And I think we are of the opinion that we need to continue to produce a set of solutions, of which the hydrocarbon will be a solution for the medium term, along with continuing aggressively to invest in alternatives, be it wind, solar, hydrogen, and all of those require storage solutions, which we continue to want to look at.
If that is the difficult problem, now we end our conversation on the maybe easy problem, obviously not, but geopolitics was certainly at the forefront in 2021. A lot of cases we've seen, even recent days, very serious tensions on the Ukraine-Russian border. We've got the nuclear talks in Vienna, the Iran issue, the nuclear issue there bubbling up seemingly in a complicated place. And even one of the more dominant narratives through the year, the China-US moving into a Cold War, perhaps an overused analogy, but nonetheless a difficult relationship there. How do you reflect on some of the geopolitical hotspots over the last year?
I think they've all the issues you mentioned, and I'll throw in the other favorites such as Libya and Venezuela too. All those issues have been on boil throughout the year. But I think the real push-pull, my takeaway this year has been looking at the resilience of demand in the economy despite COVID. So a full recovery of global demand to 2019 levels and higher, versus a very precise response by OPEC and OPEC plus to try and balance supply demand. In the background, whether the US would be able to agree to JCPOA terms and conditions with Iran has been there. Obviously, it's a catch-22 because Iran does not view an executive order as sustainable on the medium term, because the change of administration could change it again. So they're saying, you've got to give us an incentive to come back to the table. And by the way, we are selling our production into non-dollar markets, non-fungible markets on an ongoing basis. Sanctions have not been enforced in any notable way. So they feel that they can continue to act with impunity. The US has limited tools to bring them to the table. So it's a difficult balancing act, but the US and other nations should be concerned about continued nuclear enrichment, which is clearly happening too. So that is one area of balance. You then have, as you indicated, the concern by Russia as to what's happening on their borders with an ever-expanded NATO presence and support in the Ukraine, and how are they going to react to that? Obviously, the world from a Russian perspective, sitting in Moscow looking south, is very different than the world from our perspective or US perspective looking towards the Russian from the West or from North, from across the Atlantic or from Northwest Europe. So trying to understand how to reconcile that is complicated. And yes, the Chinese-US tensions in the South China Sea and beyond, and the US and China's interest to try and continue to secure its raw material supply and use its growing international reach to make sure that it has all its necessary energy and raw material supplies, is going to continue to cause tensions, especially as the West realizes that they have probably been less strategic in solving for some of the base raw material supplies that they need in order to compete in a new energy or sustainable energy environment. So there's certainly a lot of tension there.
If one just drills down into one of those issues, let's say the Iran piece, we've seen in the region a lot of bilaterals taking place. We had the UAE go into Turkey, first time in a long time. UAE go into Tehran for meetings. We've had the leadership of Saudi Arabia tour the region, Turkey into Qatar, all of these only in the last week. How do you read all of that regional activity while these nuclear talks are ongoing in Vienna?
Listen, we don't have any specific insight. We're an energy company. We're not a political organization. But
but you watch it, obviously. You see it like everybody else.
For sure. And the consensus. I mean, the view is that as the U.S. has taken a step back, or perceived, whether they have or they have not, the perception that the U.S. has taken a step back in the Gulf and exerting influence in the Gulf.
It certainly has been consolidated, that idea, at least, since the withdrawal from Afghanistan earlier in the year went so badly wrong.
Correct, and the U.S. and the West, and the question mark, the growing question mark as to what the U.S. is willing or not willing to stand for geopolitically, then I think, or we think, that the alliances between the Gulf states and the various axes of support, including Turkey, that have happened, and Israel as a regional operator, they have begun to realize that they need to work together and fend for themselves, because they could not always or might not be able to always turn to the US for whatever strategic support they need. So I think it's a telling of the current geopolitics that the region is saying we need to create our own alliances and we need to create our own stability in order to try and consolidate the growth platform that we need to attract to be seen internationally as a stable area and to attract direct foreign investment, which the Saudis for sure are very actively pursuing with NOM and the emergence of a much more transparent, if you will, from an investment point of view, arena. Obviously, there's issues there that still need to be dealt with by them, and the UAE is very much seen as a viewing themselves more and more, not only in North Africa, not only in their region, but also in places in North Africa, including the Sahel, as to how to try and stabilize the region a little bit. Obviously, there's some big issues, Syria and the Iranian interface there, Lebanon and the Iranian interface there. They don't affect the day-to-day oil market so much because of limited demand there or in limited production. But in terms of the region, there's clearly an effort to try and reestablish a new sense of cooperation, collaboration, to try and stabilize, because clearly engagement with Yemen has not worked. It's cost billions. It's affected hundreds of millions of lives and to little gain. And I think there's a reevaluation of how to engage.
Just to wrap up with the easiest question of all, now having discussed all of those amazing topics and all of those trends impacting the energy markets, what kind of range are we going to see? Going back to where we started our conversation half an hour ago, we saw a $48 to $86 range in 2021. What's it going to look like in 2022? Can't be as wide as that, one would think.
No, I think it's going to be towards the upper end of the range and consolidating there with potential upside depending on incremental demand. But we've cleared a huge amount of inventory that was accumulated through middle and second half of last year. We've cleared that inventory. OPEC has been slowly ramping back production. They're not far from being at baseline rather than below baseline. And OPEC plus is the same. And we will feel the impact of a reduction over the past few years of capital investment in sustaining oil production over the medium term. And I'm assuming that demand remains at current levels plus or minus, then we are going to be incrementally looking for the marginal barrel. And to me, that's a trend which is there. And unless something changes on the demand equation, the only real way to regulate that is through price management of demand.
Well, we had the Saudi energy minister this week also do his warning to those who will short this market. He made that warning earlier in the year. It seems like they're pretty determined to defend prices. We've had an average on Brent $70 this year. You would expect, your words indicating something similar for next year?
So you gave me the range of 40. I think you said 46 to 84, something like that. So I'm at the upper end of that range to be there, and with upside potential depending on incremental demand. And again, that's a personal view. That's not a company view. That's a personal.
Sure. Well, it certainly looks like OPEC Plus are indicating their willingness to defend that space, so to speak. And they certainly have done so this year, you would say, pretty successfully. I doubt they're willing in any mood to give it up next year. We'll have to wait and see, but we'll have to wrap up our chat there. Chris Bake, the last word of 2021 on Halftime Talk. Thank you so much for joining us.
Thank you, Sean, and wishing you and all your viewers happy holidays. And it's been a dynamic year. I think we've got to get through winter still, and at least here in Europe, rather than the Middle East, we are looking tentatively at the gas situation, the power situation, because we're seeing pricing at some pretty eye-watering levels, and hopefully we manage our way through and we can get through the winter without too many fireworks. But it's going to be interesting.
Well, hopefully no lights will have to be turned off. We'll have to turn this one off. Thank you, Chris. All the best.
Thank you for your time. Thank you. You too. Bye-bye.